Welcome to another episode of Delta Investments Deep Dive, where we go in depth and unpack our research on specific stocks and discuss the risks. We're recording this episode on Monday, April 6, 2026. U.S. stock markets ended slightly higher as the S&P 500 index and NASDAQ composite recorded their fourth consecutive winning sessions. Investor sentiment was primarily driven by cautious optimism surrounding a potential 45-day ceasefire in the U.S.-Iran conflict, despite a looming deadline set by President Trump for the reopening of the Strait of Hormuz. Oil prices remained volatile, with crude trading near $112 per barrel, while the market continued to digest a stronger-than-expected March jobs report that added 178,000 positions.
That is the macro picture out there today. But I think we should zoom in on something much closer to home. Because if you're listening to this on your smartphone right now, or maybe streaming it over a cellular connection to your car, there is a very real coin flip chance that the data hitting your ears is flowing through physical equipment built by a company that, believe it or not, started out repairing telegraphs.
150 years ago, to be exact, a tiny telegraph repair workshop in Stockholm back in 1876. And today, they are literally building the connective tissue of the global digital economy.
Exactly. And the telecommunications industry they operate in is moving at an absolutely blistering pace right now. We are no longer just, putting up steel towers to get 3 bars on your phone. We are transitioning into an era of incredibly advanced programmable networks.
Yeah, and the recent headlines paint a really fascinating picture of this shift. We just saw that massive partnership extension with Virgin Media O2 over in the UK.
They are powering the vast majority of their radio access network, which is the actual hardware connecting phones to the core network, and they're doing it using programmable 5G standalone capabilities.
5G standalone gets thrown around constantly in the tech press. Functionally, this just means they're finally cutting the cord from the old 4G infrastructure, right? Early 5G was basically just a shiny new radio bolted onto an old 4G brain.
Exactly. Standalone is a completely new cloud-native architecture. It's what actually unlocks the ultra-low latency and massive device capacity we were promised years ago.
You see the physical application of that tech happening simultaneously in the Middle East. Over in the UAE, Telco just completed a successful proof of concept for 5G fixed wireless access.
Yeah, and using advanced millimeter wave technology.
Which is wild stuff.
It really is. Millimeter wave uses these tiny ultra-fast radio frequencies that carry just a massive amount of data. Now, they do struggle to go through walls, but if you have a clear line of sight, it essentially replaces the physical fiber optic broadband cable running to a house with an invisible, hyper-fast 5G beam.
So we are really seeing 5G pivot from a marketing buzzword into a highly functional, deeply monetizable utility. And what's crazy is that these futuristic technical milestones perfectly coincided with a massive historical one. As we mentioned, the company behind all of this celebrated its 150th anniversary just a few days ago, on April 1st, 2026. This leads us to our company of the day.
We are looking at Ericsson, trading under the ticker symbol ERIC, and our mission for today's deep dive is to really unpack Ericsson's 2025 financial reports, dig into their honestly rather dense strategic white papers on AI native networks, and synthesize the latest analyst notes.
We need to determine if their massive strategic pivot, attempting to morph from a traditional hardware utility provider into an AI-driven software platform, is actually going to drive their next decade of growth.
Or if they are going to drown in the legacy mechanics of their own industry.
Exactly.
Yeah.
So let's start with the reality of the telecom industry today. Because winning massive contracts in the UK and UAE, that sounds incredible. It looks great on a press release. But we see these giant 5G rollouts happening everywhere. So I have a really fundamental question about the ecosystem.
Yeah.
Are the network operators actually making any money from all this, or are they just bleeding cash to keep up with the technology treadmill?
That is the defining dilemma of the entire sector right now. If we look objectively at the macro environment they operate in, it is brutally challenging.
Brutal in what way?
Well, the global radio access network market, the RAN market, is expected to remain completely flat through 2026.
Flat. Wow. You drop that word in a room full of growth investors, and you'll see people start backing toward the exits.
Understandably so. The coverage phase of 5G is largely in the rearview mirror. In most developed markets, the towers are up, the concrete is poured.
Yeah, the heavy lifting is done.
Exactly. We are now in what the industry calls the capabilities phase, which involves upgrading to that standalone 5G we just talked about. But the telecom operators, the AT&Ts, the Vodafones, the companies actually buying Ericsson's equipment, They are under immense financial strain.
Because they took on massive capital expenditure burdens to build these networks in the first place.
Right. And it isn't just the construction costs, it's the operational costs.
Yeah, I like to think of the current 5G landscape like building a massive, state-of-the-art superhighway. You pour the concrete, you built these beautiful 8-lane overpasses, but the toll booths aren't collecting nearly enough money from the drivers to justify the construction loan.
That is a perfect analogy.
And to make matters worse, the electric bill just to keep the streetlights on is bankrupting the city.
That captures the telecom operator's plight perfectly. The energy costs to run these massive data networks have absolutely skyrocketed. The operators are desperate for networks that can optimize their own power consumption autonomously because running them the old manual way is financially unsustainable. But the structural challenge for Ericsson goes much deeper than just high electricity bills for their clients. The TBR analyst report highlights a severe vulnerability. Ericsson relies on communication service providers, CSPs, which is just industry jargon for traditional telecom operators, for an estimated 97% of its total revenue.
Wait, 97%? That is a terrifying level of concentration risk.
It's the ultimate choke point. Just imagine you've invented a revolutionary, agile new software platform. But legally or structurally, you are forced to route 97% of your sales through a traditional, highly regulated municipal water utility.
Oh, wow. That sounds like a nightmare.
It is, because CSPs are heavily regulated, capital-intensive, and notoriously slow-moving. They are also intensely territorial and very hesitant to collaborate with each other for competitive reasons.
So Ericsson basically has this cutting-edge enterprise technology, but their main distribution channel acts like a bureaucratic traffic jam. They can't easily sell directly to the factories or hospitals that actually want the tech. When you look right now, what is the untold story behind their balance sheet?
Well, given everything we just outlined, a flat market, cash-strapped customers, and a congested supply chain, you would naturally expect the balance sheet to look pretty grim. But the untold story here is that Ericsson's profitability and cash position are actually surging.
Yeah, I saw this in the 2025 net sales data and honestly did a double take. On a reported basis, sales actually dropped 5% to 226.7 billion Swedish krona. But you really have to peel back the layers here.
You do, because reported sales include a lot of noise. That 5% drop was largely driven by currency headwinds, the exchange rates working against them, and the divestment of a specific business unit called iConnected.
Right, so it's not the core business failing.
Exactly. When you strip all that away and look at organic growth, which measures the actual health of their core continuing operations, it was up 2% for the year. And even more compelling, in the fourth quarter of 2025, that organic growth accelerated to 6%.
A 6% acceleration in a market we just established is completely flat. That means they're actively taking a bigger slice of a pie that isn't growing at all.
Precisely.
But what really jumped off the page for me was the margin expansion. We are talking about an old-school, hardware-heavy company achieving its 9th consecutive quarter of adjusted EBITDA margin expansion.
And for anyone not deep in the accounting weeds, EBITDA stands for earnings before interest, taxes, and amortization. It's essentially the purest look at their raw operational profitability before the accountants start moving money around.
Right.
Achieving an 18.1% EBITDA margin for the full year in a flat market is a massive feat. Because of that profitability, they're sitting on an absolute fortress of a balance sheet. We're talking about a net cash position of 61.2 billion krona, and they generated 26.8 billion in free cash flow over the year.
How do they actually pull that off, though? I mean, you don't expand margins for 2 straight years in a stagnant hardware market just by selling a few more antennas.
No, you certainly don't. You do it through ruthless, surgical operational efficiency. They didn't grow their way to those margins, they cut their way there.
Ah, right. The layoffs.
Yes. Ericsson reduced their global workforce significantly, bringing it down to 88,826 employees by the end of 2025. That includes eliminating 5,000 jobs over the past year globally, with another 1,600 cuts currently proposed in Sweden.
That is a massive reduction in human capital. We're talking over 6,000 people. But here's the question. How do you slash that much headcount at a highly technical telecom company without the network literally falling over? Or without completely stalling out your research and development?
Because they aren't blindly firing the engineers inventing the future, they're consolidating legacy divisions. When an industry transitions from maintaining older 3G and 4G physical hardware into managing automated, software-defined 5G networks, you simply need fewer human hands turning wrenches on towers.
Right, that makes sense.
They are streamlining their internal operations using the very automation they sell. And despite making the company leaner, they maintain total market dominance. Today, Ericsson carries about 50% of the world's mobile 5G traffic outside of China.
Half of the world's non-China 5G data flows through their hardware. That is an almost impenetrable moat, and they are taking all that free cash flow and directly rewarding the investors who stuck around through this painful restructuring. The board just proposed a 15 billion krona share buyback program, which is actually the first one in the company's entire history, and they increased the dividend to 3 krona per share. In total, they are returning up to 25 billion krona to shareholders.
It signals immense confidence from the management team. They believe the worst of the macro environment is priced in.
But I'm going to play devil's advocate here. If you were a technology company returning 25 billion to shareholders while actively laying off thousands of employees, are you sacrificing tomorrow to prop up the stock today? Are they just trimming the fat, or are they amputating a limb to lose weight?
It's the exact question institutional investors are asking right now, but the data strongly suggests they are strictly trimming the fat.
How so?
Well, even with those massive headcount reductions, Ericsson still spent 48.9 billion krona on research and development in 2025. Think about that proportion that is over 20% of their total revenue poured directly back into the lab.
Wow, 20%?
Yeah, they currently hold over 60,000 granted patents. So they are not starving the engine, they are just stripping the heavy legacy body panels off the car to make it go faster.
Okay, so if you look at their playbook for the next 5 years, what is the ultimate endgame here? We know they have the cash, we know they are aggressively funding R&D, so where exactly are they deploying that capital to escape the gravity of those slow-moving telecom operators?
The end game is to pivot from being a company that sells physical metal boxes to telecom operators into a high-margin software platform that sells directly to enterprise developers. They essentially want to Americanize or platformize the global telecom industry.
And the tip of the spear for this strategy is their API platform pivot, right? Driven by that new joint venture called Aduna.
Precisely. And this traces back to their massive $6.2 billion acquisition of Vonage a few years ago. The goal is to turn the entire global 5G network into a programmable ecosystem. Instead of just selling a router or a tower, Ericsson wants to sell global application programming interfaces, APIs.
For anyone listening who doesn't write code for a living, think about how modern apps work. When you order an Uber, Uber doesn't build its own global map system. It plugs in the Google Maps API. It doesn't build a massive banking processor. It plugs in the Stripe API for payments. You write a few lines of code, and you tap into billions of dollars of infrastructure instantly. And Ericsson wants to do the exact same thing, but for the network itself.
Exactly. Imagine a software developer for a remote surgery robotics company. They don't want to call Vodafone and negotiate a 6-month custom contract for faster data. With Ericsson's API platform, that developer could write a few lines of code and instantly request ultra-low latency, precise device location data or prioritized bandwidth directly from the 5G network, on demand, anywhere in the world. Analysts project this enterprise API space could become a $10 to $30 billion market.
Let's talk about the execution risk, because it is massive. The analyst notes we reviewed pointed out that Ericsson has already had to take significant financial write-downs on that Vonage acquisition.
Yeah, the integration hasn't been a smooth ride at all.
Right. You are trying to mash together a 150-year-old Swedish hardware manufacturer with a fast-moving cloud-native software culture. So is this API platform a stroke of genius that redefines the company, or is it a money pit they are too stubborn to abandon?
That tension is the central battleground for Ericsson's future. The legacy telecom culture moves in years, software moves in days. But Ericsson has one unique advantage that the software companies don't. They actually control the physical networks. This is the critical bridge. You can't offer a developer an ultra-fast global API if the physical network itself is lagging, congested, and burning through electricity. That's why Ericsson's software ambitions are entirely dependent on their next major hardware leap, which is AI native networks.
Now, whenever a legacy tech company starts dropping the phrase AI native in 2026, my guard goes up instantly. Half the time, it just means they bolted a text-generating chatbot onto their customer service portal to boost the stock price.
The skepticism is totally warranted. But Ericsson's white papers on this concept detail a fundamentally different, deeply technical application of artificial intelligence. They aren't building a chatbot. They're embedding pervasive machine learning directly into the silicon of every physical node and radio tower.
Okay, so it's happening at the hardware level.
Exactly. They design their own custom chips, called Ericsson Silicon, which allows them to achieve things like a 37% reduction in energy consumption compared to previous hardware generations.
I really want to break down the mechanism there. How does AI actually save physical electricity on a giant radio tower? What is it actually doing?
It's all about predictive, autonomous micro-adjustments. Think about modern cellular towers. They use something called massive MIMO antennas. Instead of one big hose spraying a signal in every direction, think of it like a massive shower head with dozens of individual targeted streams.
Okay, a showerhead of data. I like that.
Yeah, now leaving all those individual streams running at full power 24/7 is what causes the crippling electric bills we talked about earlier. Ericsson's AI predicts network traffic patterns in real time, down to the millisecond. It puts individual antenna elements to sleep when the traffic dips for a fraction of a second and wakes them up the instant a user requests a video stream. It also performs autonomous downlink adaptation, constantly tweaking the signal strength to match the exact environment. The AI basically acts as a hyper-vigilant energy manager.
So Ericsson is essentially building the self-dimming streetlights for that 5G superhighway we talked about earlier.
Exactly. That brings it all together perfectly. It's physical hardware that optimizes its own running costs using machine learning.
But solving the energy problem for the big telecom operators is only half the battle, right? If Ericsson really wants to bypass that slow-moving distribution bottleneck we discussed, they have to go directly to the businesses themselves. Which brings us to their aggressive expansion into mission-critical and private 5G networks.
Right. If you are frustrated by the public roads, you build a private high-speed rail line. That is what private 5G is. Defense departments, massive manufacturing plants, shipping ports, public safety organizations, they cannot rely on the congested public cellular networks. They need private, secure, highly customized networks fenced off strictly for their own use.
And Ericsson has been ruthless in capturing this space. The most glaring example is their recent multi-billion-dollar agreement with AT&T. Ericsson went in and actually displaced Nokia from AT&T's network footprint.
They completely ripped out their biggest competitor to cement a massive, highly defensive moat in the extremely profitable North American market.
Yeah, and beyond just winning deals with traditional telcos, they are actively building alternative pathways to market. We saw in the research their recent partnership agreement with NTT Data.
This is a huge shift. Instead of waiting for a legacy telecom operator to slowly pitch an enterprise solution, Ericsson is partnering with global IT system integrators. These integrators are already embedded in the big corporations, so they can sell Ericsson's private 5G tech directly to the enterprises that need it. They're actively building detours around their own congested supply chain.
It's a fascinating strategic pivot. And when you step back and connect all these dots, the massive R&D spend, the programmable APIs, the energy-saving AI silicon, the private networks, it is all in service of what Ericsson's leadership calls the era of hyperconnectivity.
This is where the story really connects to you, the end consumer. Look at how artificial intelligence functions today. Right now, AI lives primarily in massive centralized data centers. You ask a complex question on your phone, your device sends that packet of data hundreds of miles to a server farm, the servers crunch the numbers and send the answer back. But the future of technology demands that AI moves to the edge directly to the devices interacting with the physical world.
We're talking about autonomous drones navigating dynamic city environments in real time. We're talking about augmented reality XR glasses that overlay complex diagnostic information onto a patient during surgery. We're talking about simultaneous, real-time language translation happening locally in your earpiece while you walk down the street.
Exactly. And none of that futuristic sci-fi technology functions if every single byte of data has to travel back and forth to a data center. The round-trip delay, even if it's just milliseconds, is too long. It requires ultra-low latency, highly programmable, AI-optimized computing at the very edge of the network. And that edge infrastructure is exactly what Ericsson is building.
They are laying the tracks for the next decade of digital evolution. But it leaves us with a truly provocative question to ponder as we wrap up today. Ericsson has undeniably built the ultimate 5G physical highway. They possess the hardware dominance, they generate the massive cash flow, and they hold the critical patents. But as they attempt to execute this grand pivot into software and APIs, can they actually transform their DNA? Or will the digital need of hyperscalers, cloud giants like Amazon, Microsoft, and Google swoop in, leverage their massive existing developer ecosystems, and steal the enterprise API market right out from under them? It's shaping up to be a brutal collision between the architects of the physical network and the masters of the cloud.
We hope you enjoyed this deep dive, and thanks for listening. Please follow us and subscribe on your favorite platforms. Don't forget to check out our Substack, Delta Investments. Until next time.
This analysis is based on publicly available information and does not constitute financial advice. Always conduct your own research before making investment decisions. By listening to this podcast, you agree that you are in charge of your own decisions and risks, and that you are solely responsible for any investment decisions you make.